Why a real estate firm, San Francisco real estate firm, bought a San Francisco office building it already owns. Why would you do that? Maybe to get rid of a little bit of debt. Just push that debt out there. We're going to learn about how commercial is wildly different than residential. Let's get into it, because this storyline, this has shenanigans written all over it, but they're legal shenanigans. Here we go. This is actually a building that we've been talking about for a while. It's we indicated, hey, it's going into foreclosure. The existing owner has defaulted on the debt. It is located at 115 Sansom Street. And so it is situated kind of on the southern end of the financial district. You've got the Embarcadero area here. You've got Tenderloin here. But this building is situated right here. It's in the financial district. Now, financial district is not overrun with tents. It's pretty clean because it's far enough away from all the riffraff and shenanigans of the Tenderloin that it's kind of just this financial district, right? And so what's happened in the financial district is everybody went to work from home and nobody came back because so many of the industry are still working from home. So you've got this downtown in San Francisco that is just wiped out. You've got 36%. I'm sorry, that's an over-exaggeration. The new all-time record number for vacancy factor percentage of buildings in San Francisco has just recently been set at 35.9%. We're going to hit 40%. That would be my guess. 4 out of 10 buildings are completely empty in San Francisco in not that long. A lot of this has to do with the subleases that are happening. I'm not going to get into that right now, but let's get into this building. San Francisco's office market has been full of surprises in the wake of the pandemic, and an interesting deal that closed last Friday is on the list of eyebrow-raising developments. It is eyebrow-raising. You're like, what? It just makes no sense. Oh, wait a minute. This makes absolute sense. How come I couldn't do that with my house during the Great Recession? How come I couldn't do that? Yeah, or houses, right? Van Barton Group, a New York-based real estate investment and advisory firm that owns several San Francisco office towers, has been selected in a recent bid to purchase a 14-story Beaux Arts office building at 115 Sansom Street that hits the market this fall. Multiple individuals familiar with the deal have confirmed to the Chronicle the firm paid about $35 million or $300 per rentable square foot for the property. The Real Deal first reported this week. Earlier in the podcast, I said it was a San Francisco investor. That is incorrect. They own property in San Fran, but they're from New York. All right. So important facts here. It's 14 stories. So you look at these buildings, they're big buildings, but they are not absolute high rises. This is an older building. It's just cool, right? It's just got that cool architecture, but it's in San Francisco. So over a third of all the buildings are vacant. They're empty. $35 million or $300 per rentable square foot is very, very low relative to the $1,000 per square foot we were at just not that long ago. So the caveat is the property already belonged to Van Barton. Yeah, well, it belonged to Van Barton until they defaulted on their loan. Their lender took it over. They sold it at auction. Hey, what do you know? Public records show the firm purchased 115 Sansom for $83 million in 2016. So this is one of those properties where we've said, all right, and we think it's going to go for about $25 million. So 83 million down to 25 million. And the individuals say it attempted to flip the property 2 years later. So in 2018, the Van Barton tried to flip from 83 to 100 million and received offers in the $100 million range, but ultimately decided to hold on to the building. Even if you got 17 million in, gross profit there, that's going to get eaten away, easily between taxes and closing costs and real estate commissions, all of that stuff. In residential, you're looking at a 10% hit. A lot of that has to do with commissions, excise tax, title reports, all that good stuff. Commercial, you've got fixed expenses in there for every transaction, whether, you're doing it without a broker or not. So the deal that closed last week is known as a discounted payoff, a situation in which an owner effectively pays off the loan on a property at a discount to its par value. In residential terms, this is a short sale. Van Barton Group owed, I think it was $53 million. So they paid $83 million for it. They put $30 million down. They owe $53, and now they buy it for $35 in a bidding war, no less. And that is something I want you to remember. This happened in a bidding war. We thought it was going to go on the market at 25 and maybe somebody picks it up. Well, it goes 10 over. And percentage-wise, that is a massive run-up relative to what we've been seeing in San Francisco. But what you're seeing is that, all right, even with a fraction, of the occupancy that you used to have, you can make the numbers run when you go from 83 million down to 35. That 35 million, you don't need as much tenants. You don't need as much rent. Your numbers make sense. They pencil, right? Because your acquisition cost is so much less. So these guys literally ditched millions and millions and millions of bad debt. And their lender was happy to do it because now they get a non-performing loan off their books. And they're like, good riddance. It's terrible. We just took it right in the booty. But what are you going to do? It's San Francisco. There aren't a ton of buyers running around at those premium prices you once had. So lenders, if they want to get something off their books, they're going to have to discount it. And that's exactly what you had happen here. So in retiring the loan at a discount, the owner now has an all equity stake in the building. They own it. They took their cash. They had their $35 million sitting on the sidelines, and they were able to purchase the building. They already had $30 million in it from when they bought it. So now they've got $65 million into a building that they own it 100%. They've got $65 million into a building that they once paid $83 million for. And they only had to come up with cash recently of $35 million. I will write a check for that. And you might say, well, since they went down a short sale road, why weren't they required to take whatever cash they had on hand, like a residential owner would have to do on their own residential property? Why didn't that happen? Because most commercial loans are non-recourse, meaning you can only go after the property itself that has a mortgage on it. Whereas residential loans are typically recourse. All right. Yeah. You want to do a short sale? That's fine. All that money you got in the bank, we're going to need you to contribute. Because if we're taking a loss, you're taking a loss. Huge difference between residential and commercial, right? So when the pandemic hit, 115 Sansom, like most other office buildings in San Fran, saw its value plummet as vacancies skyrocketed. So from, call it 100 million down to 35. I think we're at the bottom right now. Because, all right, we know that we've got XYZ percentage points of vacancy still to go. You're going to have some of the big subleases come due and people aren't going to renew them. So maybe you go 40%. But if you have dropped the acquisition cost of your property to something that's manageable, you only need a little bit of rent to make that go, to have it make sense, to be able to pay those taxes, maintenance, all that stuff. You don't need the enormous numbers required to make it go at 100 million. So more than 3 years after the start of the pandemic, upward of 1/3 of the city's offices sit vacant, and the trend of companies generally taking less space than they once required continues. Absolutely. Absolutely. But you know what? These guys are betting on the fact that at some point in time, everybody's going back to the office. Boeing's already doing it here in Seattle. Yeah, that whole thing where we're going to have you work from home remotely forever, 5 days a week. I know you got upset when we said you had to come in 3 days a week. Now we're going to 4. Yeah, don't tell anybody, but we've already had meetings and your asses are going to come into the office 5 days a week and not too long. That's exactly what's going on right now. It's so predictable. It's not they don't have employees' best interests at heart. They want to get everybody in the room together so they can get eyeballs on bodies and, what's everybody doing, right? So the 115 Sansom building was only about half full when it was listed for sale this year. And its occupancy is expected to slip even further by the end of the year when another tenant is scheduled to vacate and they ain't coming back. San Francisco's once notoriously high office rents have softened notably since March of 2020 and are now well below the rents that tenants of 115 Sansom committed to when their leases were forged prior to the pandemic. One source, who was not involved with the leasing of 115 Sansom or recent efforts to sell the building, estimated that remaining tenants are likely still paying around $80 per square foot for their spaces when average market rents are now somewhere in the 60s per square foot range. That the fact that they're still in the 60s to me is shocking because there is so much available space. I would have thought that would have dropped in half, but it kind of points to the demand that is still in place for space as it comes up. I mean, that's 80 to 60 in the 60s. That's not as big of a drop as I would have thought. The conundrum caused the building's value to drop below the value of the $54 million loan that Van Barton secured from Bank of America to purchase the property in 2016. So in 2016, they paid $83 million. They brought $30 million into play of their own. And they've got a $54 million loan somewhere in those numbers. And then the property drops even more. And then they recognize, if we default, we get out of this bad debt on a property that who knows how long it'll take to come back. We get out of that debt. We might even have a chance to buy the building back. We like the building. We just don't like the amount that we paid and what it's worth now. Right. And, when we acquired it, we had way more tenants paying more money. Weird. Market changes, right? That loan was set to come due next year. So the bank knew that as well. All right. We're not going to extend this out. Because why would we? You owe us a crap ton of money and the building isn't worth it and you're defaulting. Okay. So we foreclose, we take it back, we put it on the auction block, and then you buy it. Totally legal because commercial is a non-recourse situation. With vacancy continuing to tick up market-wide in this third quarter of 2023, people familiar with the matter say the building's lender initiated a short sale process for the property in an effort to recoup some of the debt. Getting some back is better than none. Neither Van Barton nor Bank of America responded to messages seeking comment on the 115 Sansom deal on Friday. Eric Hansen, Rob Heisler, and Adam Lassoff of real estate brokerage JLL represented Van Barton in the deal. The team did not provide comment because it's kind of a hot potato. You did what? How's that work? Oh, it's commercial? Oh, yeah. Those books are cooked, right? Building values today are well below loan values, said a San Francisco office market broker who was not involved. At the direction of the lender, they all agreed, including Van Barton, the current owner, that they would run a sale process to see what happens. All right, here's why you should be concerned about this. Who owns the vast majority of commercial office debt? Yeah, well, small and mid-tier banks that have already been rocked. Remember that whole Silicon Valley Bank deal? Yeah, that kind of just rocked things a little bit. Those types of banks are the ones that make loans on these kinds of buildings, right? Pension plans also have a lot of real estate debt in their portfolio, right? Because it's historically been very good. You've got insurance companies. Yeah. Insurance companies that have a whole bunch of debt that's about to be written down unless they just hang on to it and nothing happens. Yeah. So you've got all of these entities, pension plans, insurance companies. There's all of these different entities within our lives that we don't even think about that have this in their portfolio. And if this stuff starts to default and go sideways, if your small banks start to default, your regional banks start to default, your pension plans take whacks, insurance companies take whacks, other lenders take whacks. That's why you need to hear kind of what's going on here, because that debt all of a sudden just poof, gone, right? That debt is just, it's reduced. It's gone. It's a short sale. Something is better than nothing. The $35 million they got in the absolute write a check. The original lender gets a check for 35. Well, it's not the 54 they're owed, but it's better than nothing. So the building was listed for about $200 per square foot, pricing that reflects recent market comparables. Over the summer, 3 other San Francisco office properties traded at steep discounts, breaking up a dearth of building sales as investors grew weary of the city's office market. With a price tag of roughly 1/3 of what 115 Sansom was worth pre-pandemic, interest for the property was high. Some 24 offers were made on the building. When bids came back in October, interested buyers ran the spectrum of institutions, high net worth individuals, 1031 exchange buyers, referring to an investment tool that allows investors to exchange one property for another and defer. So it's a capital exchange. It's a 1031 exchange is an IRS allowed method to take proceeds and move it into something that's similar, like for like properties, and even foreign capital, sources said. So we're talking about who was making the offers. They are bottom feeding. These are bottom feeders. They recognize the value. These are once in a lifetime opportunities when you have something that just really rocks the market. The Great Recession rocked residential. This one, if it continues this direction, and San Francisco is particularly vulnerable because all the tech companies that used to bring their employees into the office space in the financial district, a lot of those are still working from home. And a lot of them have recognized, we don't need all this office space. Let's sublease it out. All right. There's nobody wanting to sublease it out. Yeah, we're not renewing this lease. We no longer need it. So these property owners are taking back millions and millions of square feet of office space. And the most recent one wasn't a huge one. It was from like 34% vacancy factor up to 35.9. But that was the equivalent of taking the Salesforce Tower in San Francisco, emptying it all out of people, and all that square footage just goes on the market. Vacant. It's the equivalent of an entire Salesforce building. That last little blip to get us up to 35.9%. So it's millions and millions and millions of square feet that are out there available, and it's rocking these markets. The broker who was not involved in 115 Sansom sale said that the deal was bid up. It got escalated. 25, that's cheap. Let's put a bid in at 25. We'll go to 27.5. Somebody else said, hey, let's start at 27.5. Let's run it up to 30. And then as that goes, whoever's got the listing basically works it. All right. Do I hear 32? Do I hear 32? Do I hear 33? Somebody comes in with 35. And who was it? The original owner of the building. I think it got bid up because of where it's located and what it is. It's this boutique, cool building in San Francisco that has massive issues with its commercial district. Yeah. But it just goes to show everything will sell. It's a matter how much. It's always a matter of how much. When my brokers come to me and say, I've had this property in the market for 6 months and I really don't see what I can do to be getting this sold. I've already tried this marketing, this, and this. And I always tell them, come up with an action plan to drop that price because everything sells. You just haven't hit that number yet. Oh, my sellers don't want to reduce it anymore. Well, if they want to sell it, they need to drop it. Keep doing those other things, but keep in mind, everything sells at a price. It's just a matter of how low do you have to go. Oh, my sellers don't want to do that. All right. Then they don't really want to sell, period. Oh, yeah. Okay. I'll get back to you, Sean. All right. You do that. It has the right floor plate size, and I think a lot of people really liked it for what it is. It's a cool building, in other words. It's just a less cool building when it's got $54 million in debt and it's worth 35, right? Yeah. Van Barton ultimately threw its hat in the ring. What we understand from speaking with several people who have made bids is that Van Barton essentially just matched the top price with no due diligence, the broker said. But they've owned it before. What due diligence do they need to do? They know this building better than anybody. It's like, okay. So they just literally, boom, we'll put in an offer. They already know it back and forwards. An interesting aspect of the 115 Sansom deal is that Van Barton had already invested some $30 million in equity when it acquired the property in 2016. So they had a downside. If they didn't win the bid, their $30 million they put in when they bought it for 86 is gone. It's gone. But now they've got the ability to retain that by purchasing it again, by taking their $35 million they had just sitting around in a rainy day slush fund and kicking that in, and hey, we got it. We're the winner. So experts say that having an institutional investor be willing to double down on the San Francisco market, despite its challenges, is a bright spot. And what I would say is that we are getting close to that bottom. I don't think the vacancy factor is going to go that much higher. I think it goes up to 40, and I'm just pulling numbers out of my you-know-what. But that seems to me to make sense. The beauty of me being on a podcast is you guys can look back and go, Sean, on December, right before Christmas, you said that it wouldn't go much beyond 40. It went to 42. Any comment? It's pretty close, right? So I don't think you're going to have that much. I think you're going to have the economy make some shifts and some changes. I think AI in San Francisco is going to start to really come on, meaning you're going to have more and more companies with larger and larger footprints needing space. I think that's gradually going to get absorbed, and you're going to go a different direction than we've been, which is, kiss of death. Nobody's ever working in San Fran ever again. It's indicative that quality and unique buildings in a good location are able to attract demand, said Derek Daniels, Regional Research Director for real estate firm Colliers. It's indicative that institutional capital is chasing investments in San Francisco, and local ownership groups see future opportunity in San Francisco's office market. Absolutely. And I have been saying this. I know you guys all think, what about the poop map, Sean, that you always talk about? That's there too. But this isn't the Tenderloin. This is the financial district. Wildly different deal. It's just kind of a ghost town there right now. But this building here it's kind of just one of those cool buildings, right? And it's not huge, so it's manageable. It's 14 stories. It's not a skyscraper. It's brick. It's got that, I own that building, one of those kind of things. And so to me, it has all the right physical characteristics, but the major deal here is that the company was able to retain their original 30 million effectively because they own the asset that they put that money into. And they reduced their debt way down. They no longer have 54. They have 0 because their acquisition cost was cutting a check for 35 million. So, effectively, this is a win-win for them. And to outbid somebody else by 10 million just probably isn't that big of a deal. I have no idea how large the Van Barton group is, but if they own a handful of buildings, they've probably got some millions behind them, clearly, obviously. And to already understand and know the building in and out, all right, we got this tenant. They didn't have to do any of their due diligence. They didn't have to do any of these, crazy contingencies that most regular transactions have. And this one was a short sale too. So it typically just goes to the highest bidder. All right, you wrote us a check. Thank you so much. It goes through an intermediary. But the lender is the one that takes it on the chin, because their debt is no longer, it doesn't get honored. It's a short sale. The proceeds are not enough to cover exactly, how much they are owed, but they know it. And moving forward, the odds of them getting that money back out of the property, they either got to wait for the market to fully turn back around, or, and in knowing when, the current owner defaulted on the debt, nobody's paying the bills. They're paying it anyway. They just want to get out. So that's what they've done. So huge difference between commercial and some of the new commercial loans that are coming out are also, they are recourse. So lenders are going to be able to go after whatever finances they have instead of just going after the building itself as the security for the mortgage associated with it. That's my understanding of the situation. If you're a commercial guy and I've misspoken, let me know. But it's my understanding that all the commercial loans moving forward being non-recourse loans, that is changing because, oh, hey now, yeah, we're lenders and we're taking it right, you know where, and it's not a good thing. So we're going to change up some of our lending practices here. So it'll be really interesting moving forward because you got a situation where bottom feeders are entering into the market. High net worth individuals, they're bottom feeders. They're looking for a deal. Remember when I bought that building for $35 million back in 2023, right before 2024? Man, that was a stroke out of the park. That's literally what guys are running around doing because it's feeding frenzy. You know, the chum is in the water. You've got dead carcasses of buildings just kind of floating around with, half of the tenants in there that they used to have, and all kinds of other craziness in the marketplace going on. You got the doom loop. You got people doing tours of the doom loop. You got APEC coming in and cleaning up and then all of a sudden just letting it go. You got the poop map. I mean, you've got it all going on in San Fran. But these investors, they look at one thing, and that's return on their money relative to risk. It's a good risk. It's a good risk. Folks are still saying San Francisco is a good risk, and I would have to agree with them based on historical numbers. It's just a matter of how far does San Fran, how long and how far does San Fran come back? Does it come back? Yeah, stay tuned, right? Stay tuned. I'll be talking about it right here. Thanks again for being here. I'll catch up with you on the next one. Bye for now.